Well, hello to all of you, and different time of the day. We were getting so many people asking us about Brexit and what our opinion was on Brexit and whether we thought it was going to have an impact or not, that we thought we'd do a webinar. Unfortunately, we've been really, really busy and off to America in less than 10 days' time. And so we thought, well, let's do it. We normally do the webinars in the evenings. And so we thought we'd do one today and at least get the information out there. Just in my interest, before we get started, I'd like to just see the people online. I know it's not a very demographic way of doing it because everyone who's online obviously prefers it during the day. But do you prefer webinars during the day or in the evenings on like a Tuesday or a Wednesday? This should give you a reason to start communicating. If you haven't used it before, you'll see this little questions box and you'll actually be able to see the information come up there. So I have to say I prefer doing it during the day. It doesn't necessarily go into my family time with my family, but I'm just interested what people's opinions are. So I can see there's a whole lot of comments coming through saying the daytime. I suppose if I did the webinar at night, all the nighttime people would say nighttime. So, it's just interesting for me. So really today is an interesting topic, and it's around Brexit, and I think Brexit came as a very big surprise to a lot of people, including most of the population of the UK, because I think they were not expecting what has actually happened, not in the fact that they were going to effectively vote for Brexit, but equally where they were told about all the economic calamities that were going to come. And when they came, now they all seem surprised, which is a bit weird. But what I wanted to discuss is what are the impacts that Brexit is going to have on the property market, both in South Africa and globally, how one can benefit from that. For me, I learned a huge lesson when we had Lehman Brothers go bankrupt in 2008. There was tremendous opportunity, and often in uncertainty, there is opportunity. And so for me, I think it's a similar situation. And I want to go through today and talk through some of the fundamentals and some of the lessons that I think will be of value. The first thing that I wanted to talk about was, what does Brexit actually mean? And what I found absolutely fascinating is that over the last 2 weeks, I'm obviously subscribed to a bunch of emails and I follow different people on LinkedIn, etc. And what I found absolutely fascinating over the last 2 weeks is how everyone has an opinion on what Brexit means, but you'll notice one very strong correlation. So this is a group that helps people invest in property in America, and they believe that Brexit is good news for USA real estate. And they talk about a silver lining here and how it's ultimately going to be a windfall for US real estate market. This one's pretty interesting because these guys do commercial crowdfunding real estate, and they basically talk about how the UK's exit benefits US REITs. This one's interesting. This is the Scotsman's Guide, and it talks about how Brexit is going to boost USA commercial real estate. This one's quite interesting. I found this very interesting. So these guys are, are in Europe, and they basically talk about how Brexit is now going to help people in Sweden with properties. This is the Credit Suisse report, and they're talking about the implications of Brexit and what they suggest from an investment perspective. This is IP Global, and they basically have a whole article on Brexit, a nation decides. What I find fascinating is that they then go into the article in a lot of detail, and they explain why, in their opinion, Brexit actually means it's a good time to buy. So they talk about how domestic buyers are driving the property trend, and British occupiers are responsible for the vast majority of purchases in the UK, and this demand is going to continue. They talk about what happened there? They talk about well-located properties and not necessarily investing in London right now, but areas like Manchester, Birmingham, and Liverpool. And one that I find really interesting is that they say that because of the lack of trade agreements, it means that costs are going to go up because of labor and imported materials, and that's going to increase the price of houses. So very interesting that they turn Brexit around and they say that it's a good place to invest in England. They obviously help people invest in England. So for me, there's one very, very common theme that came through with all these reports, and ironically, I actually saw an email, and I couldn't find it yesterday, from someone, and I think it was Triok, that said Brexit is really good, and that means that it's going to be good for the South African property market. And I unfortunately couldn't find the email. But what I find really, really interesting is that there's a common thread through all these emails, and that it's no matter where the person is based and no matter where they help you invest, in their opinion, Brexit is good for their market. And for me, that's a major, major problem, because the one thing about investing is that it's cyclical. The other thing about investing is that you need to be able to be diversified and in different markets, because there's the right time and a wrong time to invest in markets. The third thing is that you need to have a balance of different assets within, the diversification. And the fourth thing is that if you listen to an expert that only knows one market, they're always going to use facts and figures to pretty much tell you why their market is the best. And Dolf de Roos has a brilliant saying that statistics are a bunch of numbers looking for a great argument. And so for me, I'd always say to people, be very wary of all these different reports, particularly if there's a single-minded focus, which is directly related to the only solution they actually offer. So let's look at some of the major lessons that I think that we can learn from what's happened in the past. The first one is that history repeats itself. So Robert Kiyosaki, and I've actually got the book here somewhere. Should have looked for it earlier. Anyway, Robert Kiyosaki wrote a book in the late 90s. He wrote Rich Dad, Poor Dad, which most people know. He wrote a book that I've listened to this year, which is called Second Chance, which I highly, highly recommend. And he talks about how he spoke about how the crash in 2008 was going to be the small crash, and the crash in 2016 was going to be the major crash. Now, I understand that in 2016 to kind of make that prediction is fairly common sense. But to be fair, to make that prediction in the late 90s and then to say it again in your book in 2003 is fairly impressive. So I'd highly recommend you go and read the book Second Chance. It's very much based on common sense, and it's very much based on fundamentals. And it really gives you some insight into what is actually happening in the financial industries around the world, and gives you a good insight into what you need to know in terms of where things are going. So there's another guy that I highly recommend that you look at, and that's a guy called Jim Rogers. So you should be able to see my webcam here, and you see my webcam. And this guy was actually George Soros's business partner, and he retired at the age of 37, and he rode on a motorbike around the world. He's got the world record, the Guinness Book of Records, for riding the most distance and the most countries by anyone. He subsequently done it another time with his wife in 2000. And my uncle actually met him in 1990 in Botswana. My uncle started the stock exchange in Botswana. And through my uncle, I've had the privilege of having lunch with him a few times. And, there's a great book that he's got called Street Smarts, which I read last year, which again I would highly recommend if you want to understand what's happening in the macroeconomic trends around the world. And when I had lunch with Jim Rogers, he spoke to me about the cycles of 8 years and how economies always work roughly in cycles of 8 years. And every 8 years, plus minus, there's a rise and a fall. And he spoke about how we had 2008, and to be fair, the governments had to come in and bail out the banks. And basically the debt has now just moved from the banks to the governments. He spoke about how his expectation, and this was last year when I had lunch with him in Singapore, he said that his expectation was that 2016 would be the next 8-year cycle, but that governments would effectively get into more debt and be able to, kind of keep things going. But actually it was 2024 when he saw the wheels of the bus completely falling off and effectively government's debts imploding upon themselves. So my point is, when one looks at it, history repeats itself. And I spoke a lot about it in my LinkedIn article, that there have been bubbles and busts for as long as time can go on. And a lot of people talk about the tulip mania, which happened in 1637. And according to Wikipedia, it literally says, single tulips sold for more than 10 times the annual income of skilled craftsmen. It is generally considered the first recorded speculative bubble, although some researchers have noted that Kipper and Weissing something, Europe-wide chain debasement of metal contains coins to fund warfare, featured also a mania-like similarities. The term tulip mania is now often used metaphorically to refer to a large economic bubble when asset prices deviate from intrinsic value. Now, please understand what I've just said there about intrinsic value. Because if I've learned one lesson from Henny Besaidnout, who's both my mentor, my friend, and our business partner, is that everything comes back to intrinsic value. And intrinsic value is calculated in a number of different ways. But the most important is its actual value. It's not people's perceptions, it's not people's gut feel. And two of the best ways to calculate intrinsic value, the one is based on income. So what is the return that this asset, it doesn't matter if it's the stock market or a property, what is the return that this asset is actually producing? And whether it's residential or commercial property, it's income that ultimately determines the intrinsic value. And secondly, the replacement cost of bricks and mortar. So literally a brick has a cost. And to replace that brick, as long as the fundamentals of supply and demand aren't kilter, so as long as there's more demand than there is supply, then the intrinsic value of the property has to be related to the cost of replacing that building. So in every building we look at, we always look at replacement cost, because the last thing you want to be doing is buying a building that is more expensive than if you could just build the building using today's current materials. So based on all of that, and when one looks at history repeating itself, firstly, the market moves in 8-year cycles, which we're clearly in. Secondly, whenever there's a period like this, people get all excited. Often a lot of people panic. And actually, there's a fantastic opportunity to make money. And the real reason that there's an opportunity to make money is that those people that in the 8-year cycle got greedy and tried to trace growth and capital growth, when the tide goes out, they often tend to have their pants down. And people really understand who understands what's going on, what the fundamentals are. And it's those investors that have stuck to the fundamentals that often make the most money during the crises, because they put themselves into a good situation. So for me, when one looks at the fundamentals, it's really, really interesting. And let's look at what's happened in the UK. So for me, when I look at the UK, and just by the way, I am not just jumping on the bandwagon now. I highly recommend you go and look at a video. I made a number of videos on YouTube called, and I think it says, Why the London Property Market Will Crash. And I made them in March last year. So more than a year ago, I made the videos. I also made videos in Battersea about why the market was going to crash and about the 20,000 properties which are being oversupplied. And the most important thing is that it comes back to fundamentals. I'm not a futurist. I can't predict the future any better or worse than you can. But if you consider that history repeats itself, and if you consider that there are underlying fundamentals to investing, then as long as you're watching both the cycles of history and secondly the fundamentals of investing, then it is actually a lot easier to predict what's going to happen. So if you look at London specifically, but to be fair, England at large, the average person can borrow 3.5 to 4 times their income. So it's 3.5 times if you're a married couple, like two people together, and it's 4 times if you're on your own. And I can guarantee you that in London, the average income in England is £21,000 a year. In London, £100,000 is a hell of a lot of money. So a husband and a wife together, at best, there's very few people earning more than £150,000 annually. Now, if you take that even at 4 times income, that's £600,000. So the problem is that the average English people cannot afford to buy houses. They can't afford the costs. It's called an affordability ratio, which I'm going to show you a little bit later. And so the only reason that the property market has continued to grow as it has is because of the foreigners. And as an example, there's an article here, which I wanted to share with you on, and just by the way, while I've got the screen up, you can see I actually follow, I've got a thing called Important People, of which Jim Rogers is one of them. And I follow what he's talking about. And just in my interest, he's talking about Asia and how it will benefit from the economic rise. I suggest you read that and you'll understand why we have an office in China. But I was actually wanting to show you, no, what was it again? Where's that article gone now? This one. So the mayor of London is condemning the foreign investors for using London homes as gold bricks. And they talk about the highest high-rise that is, the majority of it is actually owned more than 60% by foreigners. And really, there's been a huge amount of capital which has come out of Asia, specifically China. There's a lot of money that's come out of the Middle East. To some extent, there's been money coming out of South Africa. And it's been investing in London, in real estate. And it's been really pushing up the prices because it's based on speculation. And yet yields have been dropping. You know, yields in London now, you're lucky if you're getting a gross yield of 2 to 3%, which means you're getting a net yield of 1 to 2%. Now, the only reason it actually makes sense is because interest rates are at the lowest they've been in 350 years. And when interest rates go up, and they will go up, what will happen is that people will no longer be able to, the rent will no longer cover the mortgage. And when that happens, people don't like to lose money, so they'll want to sell their properties. The problem is that the locals can't afford the properties. So there's only one way to solve the problem, and that's a market correction. And what's really interesting is that I've been talking about this now for the best part of nearly 18 months, and now it's happening. So let me show you what I'm talking about here, because what one has to consider when it comes to Brexit is that the demand is going to have quite a significant impact. So if you look here, there's a whole lot of reports that have come out literally in the last this week around the property funds actually halting trading. And they've literally stopped. So funds have literally stopped letting people take their money out. And the reason being is that people are very, very concerned about the future prospects of commercial and residential property. So I wanted to point out to you here, large-scale outflows cause problems for commercial property, so obviously it's not liquid. And the reason that investors are getting out of it is because properties has risen 40% since 2009. And even before the referendum, there were concerns, you should be able to see my thing here, that prices had peaked. And the Brexit vote has just triggered that even further. So what's fascinating is that when you look here, and you know, I can share this article with you. In fact, let me just put it in the chat box quickly. You'll see what they're talking about when it comes to commercial real estate, and commercial real estate looked very vulnerable before we entered the referendum and was overpriced before Brexit. Add this to the fact that the material changes in immigration and market access would affect prime office occupants and the financial sector most correlated to the GDP slowdown, then this looks like the perfect storm. So what's interesting is when I was on Neck Island with Richard Branson, he said then that if we have Brexit, the UK will go into a recession. 2 weeks ago, I was with a friend of mine, and his brother works for GE, General Electric, in the UK. He works in the head office, and they had already made a decision that if England left Brexit, they would move their head office. So the question is, when you look at the different funds, companies like, you know, Rolls-Royce and Land Rover, I mean, there's huge impacts on import. But one of the things that most people don't understand is that 70% of the British economy is based on the financial industry, financial and insurance industry. And one of the reasons that so many of the multinational companies have their head offices in London is because it was easy to then access Europe. And so what one has to look at is just basic common sense. And whether the demand will continue, as everyone says. And the one thing that I've learned in life is that everything happens in cycles. So it doesn't mean that London is a bad place to invest. It just means you've got to get your timing right, which basically means you've got to have your information right and you've got to have your partners right. So you can see the whole article here. I've actually put it into the chat box. What's even more interesting that most people don't realize is that there's been reform that's come out in the last 6 months. So tax reform came out last year where they changed the capital gains tax from 12.5% to 28% for foreigners, which has a material impact on your return. And what they've done, and they've implemented this year, and it's going to take 5 years to implement, is they've impacted heavy taxation on buy-to-let properties. So just to go back to my articles here, and I'm happy to share this with you as well. You can see here it's talking all about the tax. It's talking about the regions where they're going to lose money, which I'm going to share with you just now. And it's also talking about the implications it's going to have over the next 5 years. So what's really interesting is I've shown you a couple of articles. These articles came out even before Brexit. People were concerned about the fundamentals of the market even before Brexit turned up. And in my opinion, Brexit might just be a catalyst. It might be a lot of hot air that's not as important as everyone says. But any market where the fundamentals are out of sync and where it's looking for a correction, it just needs a catalyst. It just needs a Lehman Brothers. So when you look at it here, these are the areas of how people will lose money by 2021. So 91% of places in England will actually lose money based on the increases in tax. And guys, just by the way, this is not me, this is The Guardian. And what's quite interesting is you can see the amount of money. So London, as an example, sitting there is kind of in the middle in terms of the fall of profits. What I find fascinating, though, is that they talk about what the changes will be by 2021 if the bank rate stays at the same it is at the moment. And you'll see that, will the average buy-to-let investor make a profit? And you've got no, and then you've got yes, so kind of in the central areas of the UK, the Midlands as they call them. But what's really interesting is that if the interest rates are the lowest they've been in 350 years, do you think they're going to stay like that forever? And so what they look at is if interest rate was to rise 2 percentage points, so only rising to 2.5%, basically virtually the whole of the UK will now no longer be able to make a profit on buy-to-let based on rising interest rates, but more importantly, based on tax. And so many people make a mistake when it comes to investing. And I always say that buying a property is 20% and all the other stuff's 80%. So the tax, the structuring, the compliance, the management, the maintenance. And so you've got to have a really good understanding when you're looking to invest, not just on whether Brexit's good or bad, but on a number of other fundamentals. Because when you look at the numbers here, where in London you currently would be making a $5,000 pound profit based on the current kind of averages. By 2021, with no bank rise, you will actually be losing money because of the tax. And if the bank rate was to rise by only 2%, you'd be losing quite significant money. So now go back to what I've been talking about today, and to be fair, what I spoke about in my video, which I shot in March of 2015. If the cash flow is not positive, will people buy or sell property? What do you think? If you're losing money every month and there's not much hope for capital growth, and to be fair, even if there is hope for capital growth, do people like to hold on to assets that cost them money every month? Yes or no? So I've got a couple of comments going through here. Offload quickly, no sell, most wouldn't. And that's exactly my point. For me, business and investing is actually very common sense. And what frustrates me is that a lot of people get caught up in huge analyses and fundamentals and economic opinions. And actually, it's just simple common sense. If people are going to start losing money, they are going to want to sell. The problem is that if the locals can't afford to buy because of affordability issues, it equals a market correction. We saw this happen in America. We saw this happen in Ireland. We saw this happen in Cyprus. We saw this happen in Greece and in many markets in Europe. And what's fascinating is that it was only 8 years ago. I'm only 39 years old, and I've already witnessed this twice. And what amazes me is that people don't seem to be able to correlate and learn from the lessons of history. So let's keep going on the fundamentals. What I would highly recommend is that if you want any facts or any information, the place to really get your research for the UK is called Academimetrics, which is the place that I've been following now for as long as I can remember in the UK. They're not a government organization. They're not a bank who has a vested interest. They're not an estate agent that has a vested interest. They're a research house, and they just put it out there as it is. So if you go to the website, which is Academimetrics, you can get a report, and this report comes out every month, and unfortunately it comes out every month on the 10th. So I would love to have had this report post-Brexit, because you can see it's pre-Brexit, as to what their opinions are and what's happened in the market. But just a couple of things that I'd like to point out to you, even before Brexit happened. So firstly, property values dipped. This is before Brexit, by the way. The steepest fall since November 2011. London house prices fall by 0.3%, the weakest May for home sales in 5 years. But house prices in slow decline. Okay, so that's up north. Okay, so what I wanted to share with you actually is graphs. I like graphs. So you can see the annual house price change here. But what you really need to understand is this graph. Housing transactions. You see, you come back to fundamentals. And if you really understand what's going on in markets, and if you've really got systems to, or more importantly, if you know where to get the information, then you can make educated, informed decisions. So in the middle of the crash, the housing transactions per month dropped to 20,000 properties a month. The average long-term trend is 90,000 properties a month. And what was interesting is post-crash, it slowly grew and grew and grew, you know, up to in the region, you can see there, it got up to 90,000 on average. You can see all the different years. And then look at black, which is 2016. So for all these people that tell you that there's incessant demand in the UK for buying houses, it's interesting that the numbers are showing different facts. Just by the way, this was pre-Brexit. I wanted to share with you one other graph. Where's it gone now? Which is all the different areas. You can see the different growth points. But this was the growth. So again, there's been quite significant growth in some areas, and that's a good thing. And like I showed you in that first article, since 2009, there's been significant growth both in residential and commercial. But just like the tulip mania, the numbers don't make sense. You can't buy an asset and earn an income of 1 or 2%. Long term, if you want to be sustainable. So let's keep going. Fascinating. 48 hours ago, I got a WhatsApp from a good friend of mine. I've been, FC has been a friend of mine for, well, you know, nearly 20 years now. And, no, sorry, about 16 years, because I went to London in '99. I lived there for 9 years, and he and I became friends in London. And he's got an amazing business there. He was bringing in South Africans, and he was helping them rent houses, and he had a whole business around it. And we've always spoken about actually buying the underlying assets, and both of us tried very aggressively to buy in 2008, 2009. But to be fair, we didn't have our structures in place, and that's why we created Wealth Migrate, so that we could bring buyers together when there were great opportunities. And you know, I often speak, and you might have heard me talk about it before, but in Wimbledon, there were 48 units that were at a more than 50% discount. So literally, 3 months before, 86 South Africans had bought them at £320,000, and I could now pick up the units in the same building that were finished, furnished, and tenanted with 11 and 12% returns at £160,000. And the problem was I needed £10 million, and I didn't have £10 million, and I tried to run around and get the money, but I just couldn't get it quick enough. And I tried to actually buy one unit, and they just laughed at me, because they only do bulk deals, you know, where you buy the whole building. So what's really interesting is 2 days ago, or that pain created us to cause Wealth Migrate, and I've been looking forward to the next crash, because we've been getting ourselves ready for the last 6 or 7 years to be able to participate when the opportunities come. And 48 hours ago, I got this WhatsApp from, and ironically, someone who's online tonight, Salish, and I have known each other for a long time, and we were literally having this conversation on Wednesday morning, and ironically on Wednesday evening, I got this WhatsApp completely out of the blue. I wasn't even asking for it, and suddenly FC sends me, from January, we can start buying bargains. And I said, please send me an info as I'm doing a presentation on Friday, obviously today. What kind of info, property or investment strategy? No, just anything on the market we're ready to swoop this time in a big way. So I'm giving you a little bit of an inside track on my personal life here. And he said there is an undercurrent of insecurity and a fear after Brexit, as the happy season is over and the grey and dark again will be easier to pick up bargains with a cash fund. Then we'll wrap them up nicely, gear them up to a portfolio of 6 to 9% with the entire chain under control. And he went on to send me some articles, which is very interesting, that more than 12 months ago, a video in Battersea. So Battersea Vauxhall is the other side of the river, which used to all be industrial land, and the developers have gone in there in a big way. There's over 20,000 units all coming online within a 2-year period, and the majority of the investors are foreigners. And for me, it's just simple fundamentals. And I said, guys, it's not going to work. It's going to crash. Because, again, the prices are too expensive for the locals. And interesting enough, I got this just yesterday, where basically one of the biggest developers is already taking a hit. There's already been a 3.75% fall in prices, but they're actually expecting, they've had to effectively revalue the entire development project because of concerns around bubbles in Battersea. Now, I'm not telling you this to brag. I'm just showing you how, if you use common sense, if you follow a system, if you know where to get the right information, and if you follow fundamentals, then these trends become quite obvious. What's also interesting is that this article, property funds plunge as Brexit spooks. I just wanted to read you some of the points. I've got the thing here. It talks about how Standard and Life have blocked people taking money out of their fund from Brexit. British Land Securities, Barratt Developments, and Berkeley share price have all fallen. The Brexit-induced property crash is causing investors to flee the sector. So that's what it's showing. I'll actually put my mouse where I'm reading. The value of the property portfolios is down by at least 5% following the Brexit vote. We will see irrational pricing, which I find very interesting. And open-ended funds are badly designed because they give investors the chance to cash out each day. Now, what's really interesting is that something I learned from Henny is that we don't do open-ended funds. We don't even do blended funds. In fact, we don't even do funds. We help people invest in direct property. And what happens in times of uncertainty is that wealthy people invest in direct property with a secure income. They don't invest in liquid funds that have a more than 70% correlation to the stock market. And although people think they're investing in real estate, which as the underlying asset, they're actually investing in a financial instrument. And once again, we have a crisis and value is lost and created literally on people's perception. So what it says here is Brexit has sparked, so this is this part down the bottom here, Brexit has sparked a wave of uncertainty in stock markets, but the UK-focused property sector has been hardest hit because of its runaway success over the past few years, thanks to inflows of foreign cash. So I find that very interesting when one compares to the article that I spoke of 20 minutes ago, where someone trying to sell property in London was trying to tell you that all the investment is domestic, when yet it's very well known that the majority of the investment coming in to the property market has been foreign. Are you starting to notice some trends here? So the big question then comes in, well, okay, this is a lot of information, Scott. You really are confusing me. How does one make a decision? Where do I invest in the world? If it's not London, then where is it? Is it Joburg? Is it Cape Town? Is it Harare? Is it America, Australia? Do I try to get a passport in Mauritius or Cyprus or Malta? And the real honest answer is there's no right answer. Because really trying to say that any one place is better or worse is wrong. Because places have the right time to invest and the wrong time to invest, as long as the fundamentals are in sync. And so for me, what a lot of people get caught up in, and this is a very, very old picture and a very old slide. You won't believe it, but this was the slide I used on my very first presentation in 2004 when I stood up on a stage in London and taught people how to invest in London property. Because I'd been doing it for a number of years. I bought my first London property when I was 24 years old. And what a lot of people do is they get caught up in the short term of whether we're at the peak of the cycle or whether we're at the trough of the cycle. And what they don't do is look at the long-term trends, which again is based on the fundamentals and getting the right information. So I want to share with you some things so that you can get an understanding. What we did, and this isn't me on my own, this is with Henny Besaidnout, Dr. Dolf de Roos, guys like Alan Carnock, and many, many other people have added their knowledge. You know, we've had over 230 years now of combined experience in investing internationally. And rather than having a bunch of disparate systems, we put it together and we formulated our GID system, which is our Global Investment Due Diligence System. And you'll actually see it's a 10-layer system. It starts off by looking at currency movements. It then looks at macro analysis of scenario planning based on countries and where you should or shouldn't be investing. It looks at the financial structuring. So everything I've just spoken to you about with regards to tax. It looks at how do you get the right partners. It then, just once you've decided on a country, how do you know which city? Do you go to London or do you go to Manchester? And once you're in Manchester or London, you know, which part of London do you invest in? Do you invest in Wimbledon, or do you invest in the northeast, or do you invest in the east, or in Croydon? So you need another scenario-based planning tool. Then you need a calculator to work out the returns, because one building can be better or worse than another building. You need to go through an entire due diligence process to make sure that there's no fraud and that the property's in the right condition and that you've got all the appraisals. We've got a 142-point checklist that has been built up over decades worth of experience to try and mitigate making mistakes based on mistakes we've already made. Then it's the ongoing management and ultimately sweating the asset. It's about having a partner that can help you and hold your hand through the process, because it doesn't always go right and sometimes it goes wrong. And ultimately it comes down to customer experience. And in simple terms, what it does, when I wrote the book, Property Going Global, I tried to help people with a system, and I tried to tell them where to go and find all the information. So, as an example, in England, go to Academimetrics. The problem is that most people don't want to take that level of detail, and in the same way that when you catch Uber, they don't actually care how the algorithms helped the car find you and ultimately the driver find you and put you together with the driver. They just want to use Uber. So for me, I'm going to go into a little bit of detail around our GID system, but I'm not going to go into a huge amount of detail because it's the same to an extent as the Uber algorithms. So I wrote the book, and effectively I created a 4-dimensional model. I shared it with Clem Santa after a year because I was a bit embarrassed. And after, when I shared it with him, he was so impressed. He said that I had to write a book and that he would write the foreword for the book. So really, it started out with Clem Santa. It's been endorsed by over 40 different global leaders and property experts. And in simple terms, what it does is it takes Clem Santa's scenario planning, and he's one of the top 5 scenario planners in the world. Literally, he's worked with the Chinese government as an example. And he looks at the global economies. He's also got them for the South African economies, by the way. And none of us have an understanding of the future. None of us have a crystal ball. But what we do have is scenarios and then flags which will point us in a direction of whether something's going to happen or not. And then based on those scenarios and managing those together with the economic fundamentals, it produces predictable results as to what you should or shouldn't be doing. And so if I go into, now if you want more detail around this, you can either read my book, Property Going Global, where chapters 4 and 5 go into a huge amount of detail around this for the left-brain people. And if you want to watch the webinar with Clem Santa, I would just do a Google search, Clem Santa Scott Picken, and you can actually watch him talking about it. But what I think is really interesting is that you then go to the facts, and some of you have seen this before and some of you haven't, but so many people get caught up in gut feel. And the place I like the most is to go to The Economist, which is the most research from the top 20 markets around the world. And you'll see here that I've put in the United States, I've put in South Africa, I put in Britain, and I put in Australia. So when you look at the house price index, it looks like South Africa has been the best performing market of all 4 of them. Then you look at price in real terms, and you can see that South Africa has actually been the worst performing market. When you look at price against average income, you'll see there that the US is the most affordable market and the best value. And Australia and the UK are, a lot more expensive. And then you've got South Africa. What you'll also see here is, notice these trends. of when to invest and when not to invest. And then ultimately price against rents, it helps you know where you are in the cycle. So what I always say to people is that I've personally invested on 4 continents. So I'm not trying to tell you to invest in America, Australia, England, South Africa, because I've invested in all 4 of them. And our team has experience in all 4 of them. And therefore, we have no intention to push anyone in either direction. All that we have the intention of doing is looking at the fundamentals. And then based on the fundamentals and our system, it helps us make educated, informed decisions. We're not desperate for any one market. So what I think is really interesting is that this is now the house prices in the UK. So I've put in there Britain, I've put in there London, and I've just put in there the Southeast. And what's fascinating is you can see what's happened with house prices over the last, 25 years. Look what's interesting if you look at prices in real terms. So, for me, this is quite interesting. You can see London has grown dramatically in real terms, particularly over the last 5 years, whereas the rest of England and the Southeast has actually, believe it or not, gone fairly sideways. But this is where the information gets interesting. I'm sorry, it's exciting and interesting for me. I don't know if it is for you. Look at mortgages as a percentage of income. And if you want to understand why house prices have gone up so dramatically, it's because interest rates have gone down so dramatically. And I want to point out, are at the lowest they've been in 350 years plus since the Bank of England started. So these are the fundamentals that people need to understand. And the last one is the income multiple, which just shows prices and how much prices are based on income. Are you starting to notice a correlation in the research? Are you starting to notice why, for me, Brexit, it's not about Brexit, yes or no. And in fact, Brexit actually is going to be our best friend because it's creating uncertainty, and in uncertainty lies opportunity. But the fundamentals were already out of sync. What this does is you put the facts and the numbers into a 4-dimensional model. And what that does is it pops out at a high level macro analysis which countries to invest in. And at the moment, the UK is sitting in the low return, high risk. And Australia is sitting in low return, low risk. And the US is sitting in high return, low risk. Now, and by the way, you've got South Africa there in high return, high risk. What's interesting is that it's not always going to be like this. So when the fundamentals change and when the research change, the system doesn't change, but the results do, obviously. I don't have time to go into this in detail today, but it's all based on the fundamentals of property investing. And the one thing we can discuss is we can argue or debate about whether the market's going to go up or down, but we can't argue or debate the fundamentals of investing. So you've got economic risk, you've got the value of the discount, the property discount. So if you're buying shares when the market's at the highest it's ever been, it's kind of common sense that there's only, you've got a lot more risk than if you buy it at a discount. It's the same for property. The property fundamentals of population growth and supply and demand are one of the most important factors you need to take into account. And then ultimately rule of law. Because if you've got a asset and you're forced by a government to leave a tenant in it and you can't get rid of that tenant and you don't produce an income, then you don't have a good asset. It doesn't matter what it is. So the rule of law has a major impact. And as an example, in India, all the fundamentals make sense in India except for the fact there's no rule of law when it comes to tenant rights or, to be fair, landlord rights. And therefore it makes it a much more difficult investment. And then on the right-hand side, you've got the return index. And you'll see there that we've got a weighting of 70% on income. And that has never changed. And in times like where we are now and where we're going, if you focus on income, you will not only have a bulletproof strategy, but you'll have a strategy that will help you thrive in amongst the chaos. So let's just look at the results of this system. Now, some of you might unfortunately call this bragging, and some of you might be quite interested. So when you look at the last 10 years, I basically used the Economist, and I went back 10 years. And I thought that you would find it very interesting that we started investing in Australia at the beginning of 2008. And we actually stopped in 2011, and we started again in 2013, which is around here. And we believe now that the Australian market is very much going into the development cycle now, which means it's better to build something than to buy it. And so it's just interesting, on the timing side. Like, it's, hindsight's 2020, but I do find it quite interesting when the fact of when we started, when we stopped, and now when you look back on the research, it's quite interesting on the correlation. What about the UK? So I started investing in the UK in 2002. I invested right through to 2007. I then stopped investing in 2007 because the prices, the income, and the fundamentals didn't make sense. We started investing when Lehman Brothers went bankrupt in that 3-month period to the end of the year, so the end of 2008, beginning of 2009. And we actually invested quite heavily in 2009 because there was amazing opportunities. But unfortunately, a lot of people from around the world also got involved. And because of that, the market recovered in less than 12 months. And there weren't the discounts anymore. But to be fair, a lot of the underlying fundamentals that were wrong were still there. And so we actually stopped investing within a 12-month period and haven't invested in the UK again. And some would argue, so we experienced this little growth period. Some would argue we kind of skipped this kind of just going sideways period. But and some would argue that we missed the blip of the last, call it 2 or 3, even 4 years. And you'd be right. But I'll tell you what, my uncle is a very, very wealthy and successful stockbroker. He never waits to try and sell his shares at 100%. He sells them at 85 and he makes a profit. And he always says to me, put the profit on the table. And then lastly, the one that I'm probably more excited about is that, in America, when America went through its crisis, we all knew there was opportunity. They say when there's blood on the streets, there's opportunity. And I went to America in 2010. We couldn't find partners that we could trust. And to be fair, the numbers didn't make sense, the fundamentals didn't make sense. There was massive oversupply in the market. I spent a month there with my wife. And we watched the market and we watched the numbers and we watched the metrics. And by 2012, we decided the timing was right. And we went back in April 2012 and we started to aggressively invest and very aggressively. I mean, we've now invested and facilitated, hundreds of houses, probably in the region of 400 to 500 houses in America. We've got a massive commercial portfolio of properties, and it's all been accumulated in the last, sorry, I just need to sneeze here. It's all been accumulated in the last 3 to 4 years. But what's really interesting is that when you look at the market cycles, the bottom of the market was literally in 2012. And we literally got involved in from the bottom of the market within virtually a 3-month period. So if you get it right once, you're lucky. If you get it right twice, it's a fluke. But if you've done it over the last 10 years in 3 completely independently different markets, can we agree to some extent that what I'm showing you is not just hot air? Something else that I thought you might find a little bit interesting, and I shared this at the Breakfast Live, there was some research that our team did on if you'd invested your money as far back as 1978, so pretty much as far back as research can go, in South Africa and or America, how different would you be 38 years later? And what's interesting is you'd be 424% better off if you'd invested in America. What's also very interesting is that those people that started investing with us in 2012 have seen quite a significant increase in their net asset value by investing in America. In Australia, what's interesting, same numbers, you would effectively be 499% better off. So you'd actually be better off in Australia than you would be in America. And then in the UK, you would be 332% better off. So what I like to look at, and for those of you who know me, I don't tend to make, knee-jerk reactions. I like to look at long-term research. And what I always ask myself, and it's the reason I'm selling all my South African properties, is knowing what I know today and looking back at the fundamentals over the last 30-something years, do I think those fundamentals are going to change over the next 30-something years? And if I do think they're going to change, then I must do something different. But as Jim Rogers says in this book, if you can spot long-term trends and you think the trend's going to continue, then it makes investing a lot easier because you just follow the long-term trend. And so I just ask people the question, if you could go back to 1978, what would you do if you could have put your money into a blended portfolio between the UK, Australia, and America? Just an interesting question. It's a question I ask myself, and that's why my wife and I are selling all our South African properties. So really for me, once you've got a system, and hopefully I've shared with you a lot of the system. The one thing I didn't share, which I actually haven't even opened up, which was my bad, I apologize, is that, hang on, let me just close this out. I want to just quickly open up the index. Where should I go? Sorry, I should have had this open. I forgot about it actually. And 2 seconds. It's under funding. Come on. Okay. It would be the one time you can't find the thing. Where has it gone now? So if I don't find it quickly now, I'll stop. Oh, here it is. So this is all built into Salesforce on our back end. So I'm not going to bore you with going through it, but I just prefer to show it on the spreadsheets because this is what we originally built, and then it basically got built out into our back end technology systems. But how we analyze the country, the state, the suburbs, the transport. So as an example, how far from the CBD? When it comes to education, how far is the university? The property analysis based on the building age, the site level, the site access, the property features, the external building condition, the internal building condition. I mean, this is all built out, and I learned this from my business partner, Richard Dunn. And this gives us a whole lot of methodologies and research. And ultimately, this all gets populated into our good system. So I just wanted to share that with you. And again, it's probably going into too much detail on the algorithms of how we run this thing. The fourth thing I wanted to say, which I think is really, really important, is that people need to use their common sense when they invest. What really irritates me, and again, Robert Kiyosaki talks a lot about this in Second Chance, is that we have been trained to not understand finances. Do you think it's common sense that, or do you think it was planned or by mistake that every kid in the world that goes to school is not taught about financial education, numbers, investing, accounting? Do you think that that was just a mistake? Or do you think that it's in the better interests of big business and governments to have you financially uneducated so that you pay more tax and, to be fair, need to go to them because they're so clever and they can help you invest their money, all the while making the majority of the money in fees? And if you think I'm talking rubbish, another book I would highly recommend is by Tony Robbins called Money, Master Your Financial Future or something. Anyway, just look, Money, Master the Game. So it's Tony Robbins' Money, Master the Game, which I think I've got here somewhere as well. But for me, it really goes into the detail. And so, I always like to just look at the fundamentals again and look at the research and pretty much just go back in time and say, well, if the financial industry is there to look after us, then firstly, when we had the crash of 2008 and when we had the diabolical situation of Shemax, why did nothing happen? Why did no one go to jail when it was basically blatant fraud? They would buy a building for a piece of land for 1 million rand. They would put it into a company. They would syndicate it. They would take 26% off the front end, and they would syndicate it at 100 million rand with no value upload. And that's where Henning taught me about the principles of alignment. And that's why our 3 values are so important in trust, transparency, and alignment, because if the investor and the partner are not aligned, it's never going to work long term. So when you look at the financial industry, I found it fascinating that everyone pretty much works as hard as they possibly can. most people invest in the financial industry because they are our big brother and they're going to look after us for retirement, and we're going to retire and put our legs up and have a comfortable retirement. And yet 65% of people when they retire, at the age of 65, less than 1% actually retire wealthy. And that's fact. That's not in South Africa or India or China where there's emerging markets. That's in England, Australia, and America. And what's really interesting is that there's another 3% that they deem to be what's called financially independent. And what's really fascinating, and most people don't do this, I don't know why, but go and research what financially independent means. And in the financial industry's book, the last day you got paid your salary, if it was $100, if your pension is $75, then you are financially independent. Now for me, I think you're just 25% poorer, personally. So I wouldn't call that financially independent in any way, which basically means that every single person virtually is investing in financial instruments, and the results are less than 1% get the results they're looking for. It's common sense. So let's take a step back and look at a couple of common sense things that I believe that one can look at. So the first thing is that when there's uncertainty, wealthy people invest in fixed assets with intrinsic value. And I started off today talking about intrinsic value. And intrinsic value is only based on two things: replacement cost and income. And the reason that they look at real estate is that real estate long-term holds 49% of the world's wealth. And it's because it not only creates wealth, but it also preserves wealth. It has a direct intrinsic value. So if Uber was to disappear tomorrow, there's not necessarily any intrinsic value. Whereas bricks and mortar has a direct replacement cost to replace it. And it has stability of income, which in uncertain times is what wealthy and sophisticated investors look for. The second, common sense thing is that in the first world, there's an aging population. So in America, in Australia, in England. In fact, now with Brexit, there's going to be less immigration. And so, as Clem Santa actually said, if you put a roof over the top of England, it would be an old age home. And it's actually now going to get even worse because they're not letting any young people in, like South Africans, as an example. We used to go over and there were 1.2 million South Africans living in London at one point. And now there's very few, well, certainly very few going over. So for me, it's common sense that as people get older and as they're in the middle class, they're going to want more medical facilities. And so medical facilities and old age care and aged care is on the dramatic increase in the first world, Australia, England, and America. So why not look at getting involved in real estate that is underpinned in the medical or aged care industry? Also, when you have troubled times, people always need doctors. So they still go and see a doctor whether or not they can afford it. So doctors can always pay their rent because they don't actually go up and down like, say, an office block does, or entrepreneur, or someone like that. Secondly, when they take their premises, they don't like to move. You think about it in your life. When you went to go and see the doctor when you were 10 years old, you think about it, and almost with a more than 95% accuracy, you'll realize that your doctor, your dentist, has not moved. And if they moved, the premises still remained as medical premises. So they might have immigrated to Australia or something, but that medical premises is still there with another doctor. And so the good news is not only are they very stable in economic uncertainty, but they also like to sign long-term leases. And the third thing is that doctors are very good at being doctors, but they aren't necessarily as financially as astute as the accountants at JP Morgan. So when you negotiate with them, you get fairly favorable leases. And so for me, from a common sense perspective, that would make sense. Medical makes sense to me in the first world. In Australia, it's one of the most expensive property markets in the world. There's a very strong trend towards densification. So very much like in South Africa, where the city's kind of urban sprawl just grew and grew and grew outwards. And now what's happening is the city planners are aiming to have densification. People no longer want to travel and get stuck in traffic. They want to be close to their work. And so you're finding these transport nodes and this densification that's happening around cities And you're also looking for product that is affordable, that Joe and Jill Soap, with their 2 kids, can afford to live in, because they can't afford a big fancy house out in the suburbs anymore. And so for us, I'm going to talk about this a little bit later, but we've been developing, or Henny specifically has been developing in Australia since 2009. And he, as I said to you, he stopped for about 2 years, but he's now actively getting involved again with partners, with Richard Dunn and Paul Nadera, to get back into the development cycle, but to service the need that is there, not to try and do developments to sell to Chinese investors in Sydney and Melbourne, but to sell to middle-class Australians that want to live close to the city in densified apartments and townhouses. In the UK, I lived in Wimbledon, and when I was in Wimbledon in October last year, apparently now you can't buy anything in Wimbledon for less than £1 million. Now, I've already said to you that all my friends, if they're earning £150,000, that's a hell of a lot of money. Times 4, that's £600,000. They can't buy a house in Wimbledon. Now, Wimbledon is zone 3, by the way. It's not even zone 1 or 2. And so they're all moving out into effectively beyond zone 6, where they can catch a train. And it's called the commuter suburbs. And that's where we're finding really good value. We've got a lady on the ground there in the effectively the southwest. And ironically, I know the area very well because I played rugby, and we used to play against these different clubs. So these commuter towns and commuter suburbs, effectively around the outskirts of London, is where we're finding quite substantial value and fairly good yields. And equally, we're finding now that blocks of flats are becoming available. So again, not just buying one-off units, but buying whole buildings. And I'd like to believe that what FC was saying in his report and what's happening with the funds is that that's just going to get better and better and better. I also put a post up, and I recommend you go find it. Maybe, Kevin, if you can put it up there, from Dr. Dolf de Roos as to why wealthy people invest in commercial property and not residential real estate. I'd highly recommend that. And then lastly, from a common sense perspective, wealthy people diversify their investments, and they're in multiple countries, multiple markets, multiple currencies, and multiple asset classes. And they truly are global citizens. And up until now, I could understand why someone in the middle class would go, yeah, but that's fine because they're wealthy and they've got lots of advisors and they can pay to set up structures. Versus now, with technology, it's enabling all of us to be able to have the same benefits and to be global citizens. And so really it brings me on to the last point, which is how can technology help us? And when you look at this, the old system is broken. I don't know if many of you will know Neil Peterson. I've got his face in here. And, Neil owns Real Estate Investor magazine. And let's just say that Neil was trying to invest in a London property. The problem with the current system is that there's actually 16 different middlemen between Neil and the investment. And because of the 16 different middlemen, the fees are completely diluted. Or sorry, the returns are completely diluted. So there's no trust in the system. There's no transparency. I mean, last year at SAPOA, which is the biggest property event in South Africa, they had the top four funds and REITs on stage. And they said, we're expecting 2015, the back end of 2015, 2016 to be tough. How do you see growth? And I couldn't believe my eyes or my ears when the 4 CEOs categorically agreed that 50% would be based on the fundamentals of investing, and 50% would be, and their exact words were, reorganizing the balance sheet. And a guy called Kura, who you should know well from TV, turned around and said, so you mean financial alchemy? And I thought that they would go, no, we didn't mean that. But no, they said, that's exactly what we do. Which blatantly points to the fact that it's not around the fundamentals of property, but around financial instruments. So the next thing you need to understand is the value chain. And I'm watching the time here, but the value chain is really, really important, because if you understand a value chain in anything in life and you can move up the value chain, then you can ultimately get a better return on your time or your investment. So there's a lot of steps in the value chain of real estate, but these are the major 5. You've got land zoning, you've got the developer, you've got the investor, you've got a fund or a REIT, and then you've got you. So let's look at these returns. Well, a land developer, generally it's quite a long-term thing. It can take 3 to 10 years, where you buy a greenfield piece of land and you look to rezone it. And generally they're looking for a return of 30% plus on their money. There's a lot of risk in this. A lot of land developers go bankrupt because it's very hit and miss, and it's also very much based on economic cycles, which are hard to predict sometimes when you've got very long-term projects. The second person is the developer. So they take the land and they create something of value. So they build a house or they build a shopping center. And generally they're looking for a 25% IRR plus. Then you've got the investor. And the investor comes along and they take that house and they put a tenant in it. And or they take that shopping center and they put tenants in it. Now, very often the developer and the investor are the same thing, same person. But they are two fundamentally different stages. Because the one is you building something of value, and the other one is you turning it into an income-producing asset. And for investors around the world, they're generally looking for an IRR of around 20%. Now, what's fascinating, and something I realized over the last 5 years, is that the way that people make real money out of real estate is that they then go and sell those assets after they've got a blended return to a fund or a REIT. And the reason being is that their interests are different. So a developer and an investor, ultimately an investor, is looking for a good asset with a good return based on the income of the asset. Whereas a fund or a REIT is being paid for the assets under management, generally a 2% fee. And their incentive is not so much on the performance of the portfolio, but just on the amount of assets they have under management. And so their incentive is to raise as much money as they possibly can, because that's what they paid their 2% on, and to deploy that capital into assets. And as long as those assets can produce a return which investors are supposedly happy with, then everyone is happy and they're making lots of money. Which is why they generally aim for, returns of 5 to 8%. And if that differential is why people make so much money in real estate, when they consolidate their portfolios, they blend the income and they sell it onto a fund or a REIT. And unfortunately, us unsuspecting, unsophisticated people then get told by our financial advisors that it's really good to invest in these financial instruments, and we are lucky to beat inflation. And if I'm wrong, why, for the last 100 years, have less than 99% of people retired wealthy? Let me show you the facts. This was the business day. It came out in June the 13th this year. This is a LinkedIn article, which, if you wouldn't mind posting as well, Kevin, it's I highly recommend it. It talks a lot about the value chain. And what's really interesting here is that Rebosa's property fund has just proposed to buy a $6 billion deal with developer, the Billion Group, and it's being queried by investors who feel the group is overpaying on certain assets. Now, what's really interesting is that the same guy owns Rebosa's and Billion. So he is basically the developer. He's then become the investor by seasoning the rent, and now he's selling his assets into his own property fund. So what's interesting is they talk about the different shopping centers. They talk about the fact that we believe investors may find the price of the malls rich, given that the current economic climate and that 2 of the 3 malls have traded for less than a year. There is no sufficient track record with which to determine whether the centers are trading well enough to justify the price. And then over here you've got the financial industry talking about why it's important. The bottom line is, the guy that owns Billion Group and ultimately Rebosa's is going to make billions out of this deal. Billions and billions. And the question is, who's making the money? Is it him, or is it going to be the investors that are investing in the fund or REIT? So there's the article in more details. It's all on the LinkedIn article. So you can see the value chain. And I've told people about this, and people sometimes want to disagree or debate it with me. But for me personally, I would highly, highly recommend you really think about this, because It doesn't really change. And so one thing that I think is important is that when you take Uber, what Uber did is effectively it cut out the middleman. It cut out the taxi owners associations, and it basically put you, the person that wants a lift, directly in contact with the person that wanted to give you a lift through technology. And so in the value chain, what we say to people is, well, why, if you know what I've just taught you, are you not a developer and or an investor? And generally the response is, well, I don't have the time, I don't have the money, I don't have the knowledge, I don't have access to the opportunities, which is why all of us then have to put our money together in a fund or a REIT, and we can rely on other people to go and play in that space. But what I love about technology is it allows us now to effectively skip the middlemen and to invest with far smaller amounts of money directly into the development phase, which is what we call our growth phase or growth plan, and or the investment phase, which is the income plan. And again, people always try and overcomplicate things in life, but that's it. That's how simple it is. And so when one looks at it as a growth opportunity, just to give you an idea, there's this development that I've personally invested in Brisbane. It's called Kensington. It's live on our portal, and you can invest in this with as little as $10,000. It's an 18-month project. It's 50 units, and it's got an estimated IRR, investor return of 19.8%, call it roughly 20%. But this is obviously on the development stage, so it is slightly higher risk, and therefore, the returns, are there. Now, with regards to long-term investment, this doesn't necessarily pay you a quarterly dividend because it's a project that has a beginning and an end. So that's an example of a growth phase, generally no longer than 2 years. This one is 18 months. And as I said, if you want to get involved in investing in Australia, you can get started with as little as $10,000, and you don't need a bank account, a structure, or anything. And or you can go in the income side, which is, as an example, the medical buildings that we've been buying, the medical portfolios in America. And I mean, this is just an example of one of them, which was a $16 million portfolio. It had 7 different buildings. It required a $6 million investment. It had a cap rate of 8.5%. We got financing at 4.23, fixed at 65%. Oh, sorry, 65% loan to value, fixed for 5 years. The investor return was roughly 15%. What we liked was the building was 89% occupied, which allowed us to effectively create value. We always like to look for a value add. And ironically, this portfolio, we had it fully leased before we took occupancy. It's got blended leases with long-term leases with longer than 5.5 years, and 38% of them were blue chip. And this is a classic example of income, where it's an existing asset with an existing income. We want to be able to create value, but we also want to manage the risk and really understand from a safety perspective. So, if you take these ones, we buy the building on a 5-year basis, and we get quarterly dividends. And generally the cash-on-cash return is looking at 9 to 11%. So on the one hand, you can be part of the growth phase, and or you can be part of the income phase. And really from our side, up until now, this has been very, very difficult. People have really struggled to invest internationally. They've tended to stick in their own countries because of the massive barriers to entry, and it's very difficult with regards to banking, trust, compliance, finding the right partners, language, doing due diligence. And that's really why we created Wealth Migrate. And we're now on 5 continents. And we basically help people invest in the first world, so in America, England, Australia, and soon in South Africa as well. And the beauty is that we're not focused on one area. We don't force one area. In fact, today I've just spoken to you about Australia and the UK and America. And there's opportunities in the UK. I'm just saying you've got to be careful and you've got to know who to partner with. So as Jaco says, our CIO, he says, we've taken all this information, which I've tried to share with you for the last hour. We've taken all this complexity, economic data, market data, supply and demand, due diligence, and we've just brought it all into one place on our platform. And this is a fairly complicated slide, but in simple terms, the platform sits in the middle, and it marries investors together with the best quality opportunities and the best quality partners on a global basis. And equally for the partners, it marries them together with investors using technology simply and safely. From a platform perspective, you can go online, you can register, you can select the investments, you can transact online. And the part I love most is you can manage your portfolio online. So my properties that are on different continents and in different cities is a flippin' nightmare to manage with emails and blah, blah. And we're not quite there yet, but the future is near, where I will manage my entire global portfolio on one dashboard on my mobile phone. So these are the dashboards. You can see the kind of the global nature of it. And then lastly, when it comes to Africa and South Africa, we've been part of driving the African Crowdfunding Association. Kevin, my colleague, is sitting here, and he's done a lot of work with the FSB, really about bringing this to South Africa. So we're not necessarily saying that South Africa is a bad place, but from a legal perspective and a regulatory perspective, we haven't been able to help people invest in South Africa until we've got compliance sorted with the FSB locally. And my understanding is that that is around the corner, which is really exciting, because in South Africa, we've got partnerships with some of the biggest and the best. And, when you take guys that are, I won't mention his name personally, but he's one of the 4 wealthiest people in the country when it comes to property. Nedbank give him 100% financing on commercial deals. Would you not like to participate in deals with him? Or Henny, who's building 14 hospitals. Versus just running around and going to try and find an apartment, a buy-to-let investment, and or, going on some, course that's supposedly going to help you make lots of money, even if it's from a rich dad. And, because at the end of the day, it's not only about getting the knowledge, it's actually about investing with the right people. And so, Van Gogh said, whatever you do or dream you can, begin it. Boldness has genius, power, and magic in it. Begin it now. And I share that because, our vision, and a lot of people don't understand this, but basically a family office is something that looks after the wealthiest families in the world. And all that it is in really simple terms is that it takes all the global information and all the global opportunities, and it understands that specific family and their needs and wants, and then it marries those opportunities to that family based on their long-term plan. And our attitude with technology is, why can't we put a family office in everyone's pocket? Why can not each and every one of you who are online today have access to all the right information so that you too can make educated, informed decisions for you and your family based on investing? And so really for me, it's not about Brexit. It's not about whether we stayed in Brexit or whether we left Brexit. What it's actually about is only 2 things. And that is having the right information and the right partners. I remind you of really what we've covered today, and that is that there are really 5 things that I think are important. History repeats itself. You have to focus on the fundamentals. You need a system to make the correct decisions. You must use your common sense, and technology can now help you. And as an example of technology helping, we've got a buyer's trip coming up now on the 19th of July. I'm actually flying to America, so it's not this Monday, but next Saturday, sorry. And people actually come with us physically and come and look at our assets, both residential and commercial. And we're buying, and they come along with us, and they have the ability to be part of the process. We also have people that don't have the time, and so they give us a mandate, and they say, Scott, listen, we understand you, we trust you to an extent. Go over there, be our ears and eyes on the ground, and help us choose a property. And the third one that we started doing more recently is even our digital buyers trip, which is where you can follow us digitally and have a real life experience digitally without having to fly all the way to America. So I'd highly recommend one of those 3 if you are interested in what's happening in America. In August, our business partner Hilda, she's had amazing success in business and in life. And she'll be running for Women's Month, she'll be running a series of webinars, which I think are going to be fascinating. And every time I've done a webinar with Hilda, it's been absolutely amazing. I mean, she sold her business for hundreds of millions of rand and now has a global investment portfolio. And so there's a lot that we can all learn from her, not just women. And then in September, we've got our breakfasts in Pretoria, Joburg, KZN, and Cape Town. And we'll also have our wealth partner dinners in the same sequence as what we did. So, it's a bit of long-term planning, but if you want to, have these conversations live, obviously it's much easier to be a lot more interactive live. Then, go ahead, and if you've got any questions, ask Jenny at Wealth Migrate, and she'll be able to help you. So for me, in terms of just thanking you for your time, I would highly recommend you go on the platform, wealthmigrate.com, and sign up. And, when you do sign up, you're going to become part of our global inner circle. So you're going to get access to the best opportunities, the best deals, the best research, and the best education. You're going to receive, updated information around new opportunities. As an example, Henny's working on a deal in Australia that he's so excited about. He's like a 20-year-old, and I can't talk about that yet because it's not ready to launch. But wouldn't you like to know about it before everyone else does? You can download the white papers. So we've got 3 different white papers. We've got the 5 laws of building wealth through real estate, which is in many ways what I've been discussing today. We've got the 5 keys to offshore real estate investment, which I highly recommend. If you want to invest in England or anywhere else, please read this article. Whether you invest with us or not, I don't care. But I do care about the fact that more than 80% of South Africans lose money because they don't know what they're doing. And then lastly, if you want to be sophisticated and build a global portfolio, then there's a more sophisticated white paper on building a global portfolio. So you can get access to those white papers. You'll get a free digital copy of my book, Property Going Global, which now is 2 years old, and I am in the process of rewriting it with Virtual, although I'm hoping that Yaku's app comes out quicker, and then I won't have to rewrite it. And then obviously you'll get access to our different newsletters and events. So really for me, in conclusion, what's important is if you go to a website which we've created, and it's called foryou.wealthmigrate.com, you will get access to all of this information. Because the most important thing in the next steps for me is to educate yourself. At the end of the day, there's a lot of noise, there's a lot of hype, there's a lot of salesmen out there that are motivating why Brexit is good or bad for their area. But what you actually have to do is educate yourself so that you can make the right decisions for you and your family. The second thing for me is really focus on the digital buyers trip. And again, we've got another link there, wnbuyerstour.wealthmigrate.com. And you can literally sign up and register and follow us live. So you'll have me on the ground, you'll have Yanni on the ground, you'll have Jason on the ground, you'll have Hank on the ground. And, we've done it, myself and Dolf de Roos before, and you literally get to see what we see on the ground. You get to meet the partners, you get to see the properties, residential and commercial, and basically you get to digitally experience what we go through. On the investment side, one can look at an investment in a house, which obviously is an income investment. And as I said, I'm going to America and we're going to look at houses. And if you want to, you can do a mandate. So if you're interested, just type in the word mandate. And we will talk to you, we'll understand your needs, and we can be your ears and eyes on the ground. And or you can invest in Medical 5 Phase 2, which I'm investing in personally, which is another medical portfolio, which is commercial buildings. And that's literally going live in the next couple of week or so. So go online and pledge and show your interest. I know the last one was oversubscribed again. And then finally, if you want to get involved in the the growth phase, as an example, we've got a development in Australia right now called Kensington that you can invest in. Now, what I love most is, I've personally just invested $10,000 in Kensington and $10,000 in Med 5. And I'm basically able to play global monopoly and manage it all off one platform without having to go through all the setup costs, all the tax problems, all the structuring problems, and all the management problems. So I'm really excited about how people can build a global portfolio now from the comfort of their home. And obviously from the UK, there's a lot of good opportunities coming up in the UK. If you're interested in the UK, type in UK. And equally, if you're interested in a concept I've spoken about before called the Vulture Fund, then just type in there Vulture Fund. Now, please don't phone our asset managers because they don't know what the Vulture Fund is. Please don't phone Jaco or Jay or Michiel because they don't know what it is. But in simple terms, what the Vulture Fund is a concept that we've been talking about since 2008, 2009, when the last time the market crashed. And we needed a cash fund to be able to go in and buy assets quickly at massive discounts. And just like FC was talking about, him and I are already discussing our Vulture Fund and getting ready, because as he said, in the next 6 months, there's going to be lots of blood on the streets. And we like blood, because blood means opportunity. So if you're interested in the Vulture Fund, just type in their Vulture Fund and we'll keep you updated. There's not much more to tell you other than what I've just told you, but we're building it as we speak. And then in conclusion, go to the website, go to the portal, wealthmigrate.com. You'll get access, log in, and you'll get access to all our resources, all our information, and you'll be able to see the different opportunities that you can look to invest in. And for me personally, in conclusion, when I look back on the conversation, Brexit, and the future of global real estate and how technology can help you, well, Brexit's a catalyst. And like we spoke about, cycles, or maybe disruptions with the Brexit bloodbath, history will repeat itself. The fundamentals will remain the same. You need a system to decide where to invest so that you're not making gut feel decisions like someone tells you London's a good place to invest, and yet you don't actually know that the tax is going to have a fundamental impact. Forget everything else. And lastly, you need common sense. And hopefully today, in a fairly simplistic way, I've tried to share those 4 major points with you. And the 5th one for me really is the one I'm passionate about, which is through the use of technology, we can now make these available to everybody and not just the top 1%. And so that's really coming from my side. I wanted to see if there were any questions here. So let me just open it up. I haven't actually been watching the questions. I apologize if there were. So let me just see quickly if there's any questions here. Okay, so Clive made a comment. Financial independence is having enough money to lead a reasonable life without recourse to welfare, relatives, friends, or others. With Oz, what's this? With the Oz route, you're sitting for 2 years, no gain. So with the Oz route, you're sitting for 2 years with no gain. How can you determine which is a better option? So Carlos, it's a good question. And that's why for me, there's a fundamental difference between the development cycle and the income cycle. So personally, for my family, and I'm not a financial advisor and I'm not giving financial advice, but for my family, I actually have a blended investment where I invest some in the growth phase because I get a higher return because it's higher up the value chain, but there is slightly more risk. And I invest in the income phase so that I'm getting cash flow. And personally, there's no right or there's no wrong, but you've seen my numbers and how I feel about income. And so I have a 70% weighting for income and a 30% weighting for growth. So I don't know if that answers your question. I can see a number of people here are interested in the Vulture Fund. Sue has said interested in the UK and the Vulture Fund and commercial in Australia. So, okay, cool, Sue. Are there any other questions? I've bombarded you with a hell of a lot of information and a lot of research. And to be honest, I didn't even get started. And this is what I always laugh. Most people who know me pretty well know what goes on in the background. But I could have gone through all the different documents that I've printed and read and researched. But I tried to keep it simple. So does anyone have any questions that they would like me to cover before we finish? And I just wanted to see if there were any other. I opened up a whole bunch of web pages. So this is the one that I highly recommend if you want to understand the value chain of real estate and how technology can help. It's a LinkedIn. And what I'd recommend as well, if you like this stuff, if you think we're adding value, then go and become my friend on LinkedIn or follow us on LinkedIn, like our Facebook page, our Wealth Migrate Facebook page, and then you'll get access to these articles when I post them. I posted an article about Brexit about a week ago. And I think really that was all. There's lots of articles I've been showing you, but I think I've shown you all of them, the buy-to-lets, etc. So let's just go back to our PowerPoint, and let me see if there's any questions here. Otherwise, we can call it a day. So no, we don't have any questions. It's always a sign that I've either confused the hell out of you, bored you to death, or overwhelmed you. So not sure which one it is. But anyway, hopefully that was of value. I would love your feedback. Most of you have my email address, and or if you know me better and you're a wealth partner, you'll probably have my mobile number. I'd love your feedback. I'd love to know whether you agree with what I've said or whether you believe it's complete rubbish. And I do believe we should, as a community, have more conversation around this. So if anyone disagrees with me, I'm very, very happy to have a conversation around what your thoughts are and why it's wrong. So Albrecht said, thanks for the info, and he lives in London and don't even know all this information. So it's fine, Albrecht. When we were investing in London in 2008, 2009, one of the biggest property funds in South Africa, which I won't mention their name, I met them in November trying to get the money, funny enough, for this Wimbledon deal. And I told them there was a massive opportunity, and they told me it's absolute rubbish. They all live in London, and the market's crashing. And ironically, 3 months later, they launched their own residential property fund. So, yeah, sometimes when you're stuck in the forest, you don't see the trees. Pierre said, "Are you selling South African properties? I need rental incomes. Maybe a better idea." Maybe a better idea to wait for your SA investment initiatives in the future. Maybe I can then use my rands to invest back in rands. Yeah, well, very much so, Pierre. I mean, unfortunately for us, the technology is available. You know, we've got access to, through our wealth partners now, we're pretty much connected to every top developer in the country. And, you know, so we could literally turn the South African tap on with really quality investments. And I'm not talking houses, I'm talking right up the value chain. And unfortunately, we're just waiting on the compliance side. And one day when the compliance comes, and it's coming in the very near future, it'll also allow people who have good quality assets in South Africa, who don't necessarily want to sell, would be able to necessarily crowdfund their local asset, providing them with liquidity of, say, 50%, and then they can take that money and invest it overseas. So I actually think it's win-win for everybody. And can you send all the links on an email? Okay, Sue, I think that's a fairly good idea. So we will, have we not done? Oh, so it's not a good idea. We'll send it with a copy of the recording in terms of all the different links and everything else. So again, apologies for all the information. And something, if you are interested and want to get a copy, as I said, Property Going Global, if you sign up on the portal, you will literally get a copy of the book. And or if you go to the website Property Going Global, you can get a copy of the book, and you can see how we analyze. I was asked just yesterday, you know, should a person invest in Malta? And I basically, chapter 10, I analyzed 16 different countries, including Malta, Cyprus, Mauritius, about the whole thing around getting passports and investing and passports. So I'm not going to go into that in detail, but it's all there if you're interested. Okay, what is the tax implication on returns for investments? So Ferdy, great question. And for me, this is where we've spent so much time and energy. We work very closely with Grant Thornton, so they've been our tax and compliance guys at a global level. And there's been a huge amount of money and time spent making sure that it's tax efficient, both in America and in Australia. I'm not going to sit online here with everyone online and go into the details, because it actually depends on individuals. But the one thing I will say for all investors is that we've done thorough research on these investments in the UK, in Australia, in America. We've created vehicles that are tax efficient for investors. And we've had that all set up by Grant Thornton. So we always say we're not experts at everything, but we like to partner with the best. Thank you, Mr. Scott, for the information. It's good to learn. I'm looking forward. Okay, I'm looking forward to investing in the future. Okay, well, I see that it's 12:30, so I think it's probably time to rock and roll. And anyway, thanks for everyone who's online. If it was of value to you, great. If you think it's of value to your friends, please share it with them. And yeah, please let them know about what we're doing at Wealth Migrate. We feel very passionately that it's time to right the wrongs of the past and help everyone invest in quality opportunities, so that they too can retire as part of that 1%. And yeah, I believe purpose. I believe for I can't speak anymore. I believe that's our purpose. I believe this is a purposeful journey. It's not just about making money, as many people in 20th century businesses are. And for me, it's what needs to happen to solve some of the many challenges on the planet. So that's why we're doing what we're doing. Okay. Yeah. Okay, cool. Yeah, thanks, Michael. And I endorse what Michael said. Thank you to all the people who have helped set this up. Wonderful team that's put this all together. And Kevin, as always, in terms of making it all happen. So thank you very much. We're certainly not a one-man band. And the more they help me do, with the setup and all that, the more it allows me the time to do the research to be able to bring you these facts and figures and trends. So anyway, good team effort. Thank you for everyone being involved. Thank you very much, everyone. And I was about to say good night. But anyway, have a good afternoon and a lovely weekend. And we'll chat soon. Cheers.